Welcome to the deep dive. Really excited for what we're diving into today.
You too.
We've gone deep into just a stack of really fascinating sources,
Hmm.
and they all explore this powerful idea.
Uh-huh.
Why doing well with money? It has surprisingly little to do with how smart you are.
Right. It's much more about behavior.
Exactly, how you behave.
Hmm.
So this is a deep dive into those, often hidden forces shaping our financial lives.
And these sources, they lay out stories that, honestly, they challenge our usual assumptions. Think about this contrast. It's pretty striking.
Yeah.
You've got this wildly successful tech executive, a genius in his field, no doubt, ended up completely broke.
Broke, wow.
Yeah. We read about him, like, skipping $1,000 gold coins into the ocean just for kicks.
Seriously?
Uh-huh. And another time, smashed a $500 lamp in a fancy hotel restaurant, then just threw, like, $5,000 cash at the manager and told him to get lost.
That's unbelievable. And he
Oh.
ended up with nothing.
Nothing.
Okay, and the contrast.
The contrast is this guy, Ronald Reed. Just a humble janitor, worked at a gas station, too, from rural Vermont.
Okay.
Bought a little house for $12,000, lived there his whole life. But when he passed away at 92,
Let me guess.
he left over $8 million to his local hospital and library.
$8 million? How? No lottery, no inheritance?
Nope, nothing like that. He just saved what little he could consistently,
Yeah.
put it in blue chip stocks, those big stable companies,
And just waited.
and just waited for decades.
Patience. That's a truly powerful contrast, isn't it?
It really is.
So our mission today with this deep dive is really to help you, our listener, understand why maybe your own money decisions might seem crazy to others, or why others' decisions seem crazy to you.
And how luck and risk, well, they play a much bigger role than we tend to admit.
Right. And maybe why the most valuable financial skill isn't about complex math, but about something simpler, like getting the goalpost to stop moving.
Exactly. That enough point.
So let's kick off with this first big idea that really jumped out. No one's crazy.
Sounds simple.
It does. Maybe too simple, but it's incredibly deep when you unpack it. What this deep dive shows is that when people make what look like totally crazy money choices,
Yeah.
it's almost never actually irrational. It's rooted in something, well, deeply personal, their own story.
Exactly. Every single one of us, we've got this unique financial lens, right, shaped by our individual life experiences.
Like what?
Oh, everything. How you grew up, the income levels you saw around you, the economy you were born into, the job markets, even just pure dumb luck.
And what you've personally experienced, like firsthand.
That's way more compelling, way more influential than anything you just learned secondhand, like from a book or a chart.
That makes total sense. Think about someone who grew up in real poverty.
Yeah.
They're going to see risk and reward completely differently than, say, the child of a wealthy banker. They just can't see it the same way.
It's hardwired. Or imagine someone who lived through, like, crazy high inflation versus someone who's only known stable prices.
Their whole understanding of money, what it is, what it's for, it's fundamentally different.
Like a stockbroker wiped out in the Great Depression compared to, a tech worker in the 90s dot-com boom. Just worlds apart.
And there was that study, right, from the National Bureau of Economic Research?
Oh, yeah. Malmendier and Nagel really drives this home. People's lifetime investment decisions.
Yeah.
They're heavily, heavily anchored to what they experienced early in their adult life.
So if the stock market was booming when you were, say, 20,
You're just much more likely to invest in stocks later on. It's not about being smarter or knowing more finance theory.
it's the luck of the draw, when and where you started out.
Exactly. And that quote from the study is just spot on.
Which one?
Your personal experiences with money make up maybe 0.000000001% of what's happened in the world, but maybe 80% of how you think the world works.
Wow, 80%. That's huge. And this ties into something else too, right? How new a lot of this financial stuff actually is.
Totally. We take things for granted now, like Social Security as something that provides a meaningful retirement. That's only about 2 generations old.
And 401k.
Didn't even exist until 1978. Roth IRAs, 1998. And widespread consumer debt, like mortgages and credit cards for everyone, mostly a post-World War II thing.
And college tuition. That's changed massively too.
Oh, absolutely. Average tuition, adjusted for inflation, it's quadrupled since 1940. And now, what, 1 in 4 Americans has a bachelor's degree?
Yeah, compared to like 1 in 20 back then.
So the bottom line is, when it comes to a lot of modern finance, we're all kind of newbies. We're all just figuring it out.
Which explains why there's so much variation in how people handle money. No one's really crazy.
Just different experiences, different starting points.
Okay, so if our personal history shapes our views so much, what about the stuff we absolutely can't control?
Yeah. Luck and risk.
Luck and risk. This is where it gets really interesting, I think. The sources emphasize that so many outcomes, especially financial ones, are guided by forces just way beyond our individual effort.
They're like hidden siblings, luck and risk. Always present, but often unseen.
Okay, give me an example.
Bill Gates. Obviously incredibly smart, worked insanely hard, had a vision.
Right, we know the story.
But the sources point out this 1 in a million piece of luck he had, his high school. Lakeside School. It was one of the only high schools in the world that had a computer back in 1968.
1968? Wow. How?
Get this. The Mothers Club had a rummage sale, raised $3,000, and bought this advanced teletype terminal. Most universities didn't have anything like it then.
That's insane luck, just being at that specific school at that specific time.
Immense luck. But then think about the flip side, the counterpoint.
Kent Evans.
Kent Evans. Gates' close friend, equally talented, maybe even more into the programming early on, could easily have co-founded Microsoft.
But he didn't.
No. He experienced the sibling of luck, risk. Also about 1 in a million odds. He died tragically in a mountaineering accident before they even graduated high school.
Wow. Same magnitude of improbability, just opposite directions.
Exactly. Same force, luck, and risk, just hitting differently. It makes you realize.
Yeah, it's almost impossible to really separate skill from luck, isn't it?
It really is. Robert Shiller, the Nobel Prize winner, he was asked what he most wants to know about investing that we can't know. His answer.
What?
The exact role of luck in successful outcomes. Even he admits we just can't fully untangle it.
So when you're looking at someone's financial success or failure, yours included,
it's rarely ever as simple as they were brilliant or they were foolish. There's usually a lot more luck or risk involved than meets the eye.
it changes how you view history too, doesn't it? Like those titans of industry, Vanderbilt, Rockefeller.
Yeah, Cornelius Vanderbilt building his railroad empire, basically ignoring laws that didn't suit him. John D. Rockefeller, whose a company a judge literally called no better than a common thief.
We praise them now for being bold, visionary.
But that line between bold and reckless, it's incredibly thin, and usually you only see it clearly looking backwards.
Like Mark Zuckerberg turning down Yahoo's billion-dollar offer for Facebook.
Yeah.
Looks like genius now.
Pure genius in hindsight. But it could easily have gone the other way if things shifted just slightly. One different competitor, one change in user trends.
So the takeaway here feels really important.
It is. Be careful who you praise and admire too much, and maybe who you look down on too quickly.
Especially the extreme cases.
Exactly. Those extreme outcomes, the mega billionaires or the catastrophic failures, they're often the least applicable to your life. Why? Because they're so heavily influenced by those extreme tales of luck and risk.
So focus more on, what, broad patterns?
Broad patterns, yeah. General principles that work for many people over time, not the lottery ticket winners. Bill Gates himself said success is a lousy teacher.
Why is that?
Because it can trick smart people into thinking they can't lose. And failure, it doesn't always mean you made bad choices. Sometimes it's just...
unforgiving realities of risk catching up with you. Okay, that's a lot to think about regarding luck and risk. But what happens after you achieve some success? There's this other trap, right? This idea of never enough.
Yes, enough.
Why is defining enough so incredibly hard, especially when it comes to money? The sources had some pretty stark examples.
They really did. These real-world tragedies. Take Rajat Gupta.
The former CEO.
Yeah, CEO of McKinsey. Huge global consulting firm. Came from nothing, orphaned teenager, reached the absolute pinnacle, already incredibly wealthy and successful.
And yet
she got involved in insider trading. For what? About $17 million in potential profits?
Right.
Risked everything, his reputation, his freedom, all his accomplishments. Ended up in prison.
For money he absolutely did not need.
Didn't need it at all. Same with Bernie Madoff. Already a multimillionaire running a legitimate business before he started the massive Ponzi scheme.
And wasn't there that hedge fund example, LTCM?
Oh, long-term capital management. Perfect example.
Yeah.
Founded by literal Nobel Prize winners. Incredibly brilliant minds. They were personally worth hundreds of millions.
Right.
But they took so much risk, leveraged themselves to the hilt, all in the quest for more. And they lost everything. Wiped out in 1998.
And that was in the middle of a huge bull market, right?
Right. Not even during a crash. It's almost hard to believe.
Warren Buffett had a great quote about this, didn't he?
He did. He said, To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. It is just plain foolish.
Plain foolish. Risking something important for something unimportant.
It just does not make any sense, he said. And this leads to what the sources call the hardest financial skill.
Which is?
Getting the goalpost to stop moving.
Because if your expectations just keep rising along with your results,
you'll always feel like you're falling behind, no matter how much you have. And that feeling, it pushes you to take more and more risk.
And it's fueled by comparing ourselves to others.
Yeah.
That social comparison trap.
Absolutely endless. The sources say the ceiling of social comparison is so high that virtually no one will ever hit it.
Give me an example.
Okay, a baseball player making, say, $18 million a year. Sounds amazing, right?
Yeah, definitely.
But maybe he compares himself to the guy on another team making $340 million over his contract.
Okay, I see.
But that guy might look at Warren Buffett making $3.5 billion in a single year's market move. And Buffett, maybe he looks at Jeff Bezos gaining $24 billion in a year.
It never ends.
Never. The only way to actually win that specific game is just to refuse to play it.
Like walking out of a Vegas casino as soon as you walk in.
Exactly. That's the only guaranteed way to win there.
So defining enough isn't about being timid or missing opportunities.
Not at all. It's about recognizing that an insatiable appetite for more, just more and more and more, inevitably pushes you towards regret. You wouldn't eat until you're physically sick, right?
No, of course not.
So why do we apply that logic to money sometimes? The truly invaluable things in life.
Like your reputation, freedom, family, friends, happiness.
Yeah, all those things. They are never worth risking, no matter how big the potential financial gain, and the best way to keep them.
Know when to stop taking risks. Know you're enough.
Precisely. Know when the goalpost should stop moving.
That's a really powerful perspective. And it leads us to another, maybe quieter force in building wealth, what the sources called confounding compounding.
Ah, the quiet giant.
Yeah. And the analogy they used was, think about ice ages.
Ice ages.
Tiny, almost unnoticeable changes in the Earth's tilt, or the amount of solar radiation it gets. Magnified over tens of thousands of years, these tiny shifts can cover entire continents in miles-thick ice. Small inputs, huge outputs over long timelines.
Okay, I see the connection. Compounding.
Exactly. And this is apparently the real secret behind Warren Buffett's success. It's not just his investing skill, which is obviously huge.
It's his longevity, how long he's been doing it.
Get this. Of his, $84.5 billion net worth?
Yeah.
$84.2 billion of that was accumulated after his 50th birthday.
Wow. Almost all of it.
And $81.5 billion came after his mid-60s. If he'd started later or retired at 60 like a normal person,
we probably wouldn't even know his name. He just kept going. Let it compound.
It really highlights the power of time.
Yeah.
They compared it to Jim Simons, right? The hedge fund guy.
Yeah. Jim Simons at Renaissance Technologies, his annual returns are unbelievable, like 66% a year since 1988. That's roughly 3 times Buffett's rate.
So he should be richer, right?
You'd think. But he's actually 75% less rich than Buffett. His net worth is around $21 billion.
Why the difference?
Time. Simons only really hit his investing stride when he was 50, so he's had less than half as many years for that amazing compound growth to work compared to Buffett.
It just shows how time absolutely dwarfs even incredible rates of return.
It really does. And it highlights how bad our intuition is with exponential growth. We think linearly.
Like 8 plus 8 plus 8. That's easy.
Simple. But 8 times 8 times 8.
Yeah.
Your brain just can't grasp the scale of that growth easily.
Like the hard drive example. From megabytes to terabytes.
Yeah. From megabytes in the 50s to, 100 terabytes now on a single drive? It's just mind-boggling growth, totally counterintuitive. Even Bill Gates, as late as 2004.
What did he say?
He apparently wondered why anyone would ever need a gigabyte of storage for Gmail. He was still sort of anchored in that older, linear way of thinking about data.
Huh. That's funny. So the core lesson about compounding is?
Look, there are thousands of books about Buffett's strategies, his stock picks, his genius.
But none of them are titled.
This guy has been investing consistently for 3/4 of a century. But that is the real key, the absolute cornerstone of his success.
So the most important investing book should just be called Shut Up and Wait.
Pretty much. Because good investing, truly successful long-term investing, it's not about always nailing the highest returns. It's about getting pretty good returns.
That you can actually stick with.
Exactly. That you can stick with and repeat for the longest possible time. That's when compounding really takes off. That's when it runs wild.
And that idea of sticking with it, of enduring.
Yeah.
That leads to another crucial point, right? Getting wealthy versus staying wealthy.
Yes. This is huge. There are, millions of ways to potentially get rich. Lots of strategies, lots of luck involved sometimes.
But staying wealthy.
Our sources argue there's really only one main way. A combination of, well, frugality and a healthy dose of paranoia.
Paranoia. Like always worried.
Not necessarily worried in a negative way, but constantly aware of risk. Aware that things can go wrong. It's a survival mindset.
We saw this in those historical examples, like Jesse Livermore.
Oh, yeah. The legendary trader made a fortune equivalent to $3 billion today, shorting the 1929 crash. Pure genius.
Yeah,
Right?
and incredible timing.
But then he got overconfident, made bigger and bigger bets, took on massive debt, lost it all, and tragically ended up taking his own life.
And there was another guy in that crash, Dramansky.
Abraham Germansky, yeah. A brilliant real estate developer, also wiped out. Both of them were amazing at getting wealthy.
But terrible at staying wealthy.
Exactly. That survival skill was missing.
And this isn't just about billionaires, right? It applies to everyone.
Absolutely. Michael Moritz, the head of the venture capital firm Sequoia Capital, they've had decades of incredible success.
What's his secret?
He attributes it to being constantly afraid of going out of business. His mantra is basically, only the paranoid survive.
So it's not just about finding the next big thing.
He says it's less about growth or brains and more about the simple ability to stick around for a long time. Survival.
Like Buffett again, his success isn't just the brilliant investments he made.
It's also about what he didn't do. He didn't load up on debt. He didn't panic and sell during, 14 recessions he's invested through?
14.
Yeah. He didn't ruin his reputation. He didn't get rigidly stuck on one strategy. He didn't burn out. He just survived.
And that survival gave compounding the time it needed.
Exactly. Contrast that with Rick Guerin, friend of Buffett and Munger, just as smart, by all accounts.
What happened to him?
He was in a hurry, as they put it. He used a lot of leverage, borrowed money, margin loans to boost his bets. And then the nasty 1973-74 downturn hit. He got margin calls, was forced to sell his Berkshire Hathaway stock back to Buffett for pennies on the dollar.
Ouch. Brilliant at getting rich, maybe, but didn't survive.
Didn't have that staying power.
So how do we, apply this survival mindset?
Okay, first, prioritize being financially unbreakable over chasing the absolute highest returns.
Meaning?
Like holding some cash even when the market's soaring. It feels like you're missing out, right? Earning 1% while stocks do 10%.
Yeah, that's tough.
But if that cash cushion prevents you from being forced to sell your stocks low during a crash, the real return on that cash in terms of protecting your long-term plan is enormous. Many multiples, as the sources say.
Okay, so financial unbreakability first. What else?
Second, and this is key, plan on the plan not going according to plan.
Expect the unexpected.
Pretty much. A good financial plan isn't rigid. It has to embrace uncertainty. It needs room for error. Think about all the things nobody saw coming. 9/11, the 2008 crisis, COVID.
Right, stuff happens.
Stuff always happens. The more you need every single part of your plan to work out perfectly, the more fragile your whole situation is.
Makes sense. And third?
Third, cultivate what they called a barbelled personality.
A barbelled personality.
Yeah, like weights on a barbell. On one end, be optimistic about the long-term future, believe things generally get better.
Okay, long-term optimism.
But on the other end, be paranoid about what could prevent you from getting to that future. What could knock you out of the game in the short term?
So optimistic overall, but cautious day to day.
Exactly. Look at the U.S. economy. Incredible growth over 170 years despite wars, depressions, pandemics, constant pessimism. You need that short-term paranoia to keep you alive long enough to exploit long-term optimism.
Optimism plus paranoia equals survival.
That's the idea.
Okay, that survival mindset is critical. Now let's talk about something that seems related but slightly different. Tails. You win and lose.
Ah, the long tails. This concept is fascinating.
Explain it. What are tails?
So think of a distribution curve, like a bell curve. Most results cluster in the middle, right? Average stuff. The tails are the extreme ends, the really rare high-impact events.
Okay.
And the idea is that in many fields, especially business and investing, these few tail events account for the vast majority of the total outcome. A tiny number of things drive most of the results.
Can you give an example?
Yeah, the art collector Heinz Bergeron fled Nazi Germany, became a hugely successful dealer. His strategy, he basically bought like an index fund, huge quantities of art.
Okay.
Maybe 99% of the pieces he bought turned out to be, not that valuable. Pretty average.
But the other 1%.
The 1% were the Picassos, the Matisses, the Klees, the masterpieces. Those few tail acquisitions made him incredibly wealthy. As the source said, he could be wrong most of the time and still end up stupendously right.
Because the wins were so massive.
Exactly. It's the same pattern everywhere. Walt Disney.
Yeah.
His first studio went bankrupt. He made over 400 cartoons later. Most of them lost money or broke even. But then came Snow White and the Seven Dwarfs.
The game changer.
Total game changer. Earned a fortune, transformed the company, those 83 minutes of film. That was the tail event that drove almost everything else.
And this applies to investing too, right? Like venture capital.
Oh, absolutely. Venture capital is all about tails. Something like 65% of VC investments lose money. Most just fizzle out.
So how do they make money?
It's the tiny fraction, maybe 0.5%, like 100 companies out of 21,000 in one study that return 50x, 100x, or even more. Those few massive winners pay for all the losers and drive the entire industry's return.
Even in big public companies.
Same thing. Think about Amazon. Huge company, does lots of things, but AWS, their cloud service, and maybe Prime, those were tail events within the company that drove a disproportionate amount of its value in stock market returns. Same with Apple and the iPhone.
So if tails drive almost everything, what does that mean for me as an investor? How should I behave?
Well, remember that Napoleon quote about military genius?
Remind me.
He said a genius is the man who can do the average thing when everyone else around him is losing his mind.
Keeping your cool during chaos.
Exactly the same in investing. Your long-term success probably won't be determined by all the years when things are calm and the market's just cruising along.
It's determined by
How you react during those few punctuated moments of terror. Like the crash in late 2008, early 2009. Those are the times that make or break your compounding.
because panic selling locks in losses and makes you miss the recovery.
Precisely. Someone who just held on, stayed invested through all the recessions from 1900 to 2019, they ended up with almost 3/4 more money than someone who tried to jump out and back in.
Wow. Just doing the average thing staying put led to vastly better results.
So when you accept that tails drive results, you realize it's actually normal for a lot of your investments or ideas to not work out. That's expected.
Like Peter Lynch said, if you're terrific, you're right 6 times out of 10.
Right. Even the best are wrong a lot. Think of Chris Rock testing hundreds of jokes in small clubs. He's looking for the few tails that are killer jokes for his big special. He knows most won't make the cut.
Or Buffett making most of his money on just 10 stocks out of hundreds.
Exactly. It's not about being right all the time. As George Soros said, it's not whether you're right or wrong that's important, and how much money you make when you're right and how much you lose when you're wrong. Focus on surviving the small losses and maximizing the impact of the big, rare wins.
Okay, understanding tails definitely shifts perspective. Now, let's talk about the ultimate goal. What is money really for? What's its true value?
The sources argue pretty strongly here. The highest form of wealth, the ultimate benefit of money, the ability to wake up every morning and say, I can do whatever I want today. Control over your time, freedom.
That's the greatest value. More than fancy stuff.
According to this view, yes. Money's greatest intrinsic value is giving you control over your time. Autonomy.
And there's research backing this up, right? The happiness connection.
Yeah, psychologist Angus Campbell's work. He found that having a strong sense of controlling one's life is a more dependable predictor of positive feelings of well-being than any of the objective conditions of life we have considered.
More dependable than your salary, your house size, your job title.
More dependable than any of that. That feeling of control, of autonomy, that's what correlates most strongly with happiness.
I can totally relate to that from personal experience. I remember an internship I did in investment banking.
Oh, yeah. Grueling hours.
Unbelievable. I actually liked the work itself, the intellectual challenge, but the schedule, it was crushing. The saying was, seriously, if you don't come to work on Saturday, don't bother coming back on Sunday.
Wow.
It just hammered home that point. Doing something you love, but on a schedule you absolutely cannot control. It can feel just as bad as doing something you hate. It's that lack of control.
Psychologists call that reactance. We just fundamentally resist being controlled.
Yeah. And this ties into another cool idea they mentioned, the man in the car paradox.
Ah, I like this one. Explain it.
Okay, so if you've ever worked as a valet, apparently you learn this quick.
Yeah.
When people see someone drive up in a really fancy car, a Ferrari or whatever,
Yeah.
they rarely think, wow, the person driving that car must be really cool.
No. What do they think?
Instead, they subconsciously think, wow, if I had that car, people would think I'm cool. The driver is almost invisible.
Exactly. The car becomes a symbol of the respect they desire, not respect they're giving the driver.
That's so true when you think about it. People want respect and admiration.
But the sources are clear. That almost never comes from buying expensive stuff. It just doesn't work that way.
What brings respect then?
Simple stuff. Humility, kindness, and empathy will bring you more respect than horsepower ever will.
Good line. And this leads to that other point about wealth. Wealth is hidden.
Yes. Wealth is what you don't see. It's the nice car not purchased, the diamonds not bought, the upgrades skipped.
It's the financial assets that haven't been converted into visible stuff yet.
Right. It's money working for you, providing options, providing that control over time we talked about. It's not the spending.
So when someone says, I want to be a millionaire,
What they often really mean is, I'd like to spend $1 million, which of course.
literally the opposite of being a million.
Well,
Spending it makes it disappear.
Exactly. So there's a difference between being rich, which is often about current income, very visible spending, and being wealthy.
Wealthy is the hidden part.
Yeah.
The income not spent, the savings.
Right. Wealth gives you options, flexibility, freedom. Rich is just a snapshot of income. The analogy they used was exercise.
Oh, yeah.
Exercise is like being rich. You see the effort, the sweating. But wealth is like turning down the dessert, the treat meal. It's the discipline, the unseen choice that leads to the net positive result over time.
And it's hard to learn from wealthy role models because...
Because their success is often invisible, like Ronald Reed, the janitor. His wealth was built silently over decades. You wouldn't know it by looking at him.
Okay, so if wealth is what you don't spend, how do you actually build it? Seems obvious, but
The next point is crucial. Just save.
just save. That's simple.
At its core, yes. The sources argue that building wealth has surprisingly little connection to your income level or even your investment returns compared to one thing.
Your savings rate.
Your savings rate, how much you put away out of what you earn. That's the most powerful lever.
They use the energy efficiency analogy. Right?
Yeah, brilliant analogy. After the 1970s oil crisis, the world didn't just solve the problem by finding massive amounts of new oil. A huge part of the solution was becoming way more energy efficient.
Like cars getting better mileage, better insulation in homes.
Exactly. The U.S. today uses something like 60% less energy per dollar of GDP than it did in 1950. Finding more oil is uncertain, depends on exploration, geopolitics, but becoming more efficient.
That's controllable.
Yeah.
And it works 100% of the time.
Precisely. And personal savings and frugality. That's the financial equivalent of conservation and efficiency. It's totally within your control and it's guaranteed to work. Wealth is simply the accumulated leftovers after you spend what you take in.
Then the relationship between income and savings isn't always what you'd expect.
Right. You can build wealth on a modest income if you have a high savings rate, but you have zero chance of building wealth, no matter how high your income, if you spend everything. So it's clear which factor is more important.
And spending, especially beyond a certain point, is often driven by ego.
That's what the sources suggest. Past a certain level of income, what you need is just what sits below your ego. A lot of spending isn't about utility or comfort.
It's about showing off, signaling status.
Yeah, which leads to a powerful insight. One of the most powerful ways to increase your savings isn't to raise your income, it's to raise your humility.
Just caring less about what others think, about keeping up appearances.
Exactly. People who achieve lasting financial success, often they just genuinely don't care that much about impressing others with stuff.
And you don't even need a specific goal for all this saving, like saving for a car or a down payment.
Those are fine, but saving just for the sake of saving without a specific target, that's incredibly powerful. Why?
Because life happens.
Exactly. Saving is your hedge against life's inevitable ability to surprise the hell out of you at the worst possible moment. It buys you options, it buys you flexibility, it buys you that control over your time. It lets you wait for good opportunities instead of being forced into bad situations. That unseen return on wealth is huge.
And in today's world, that flexibility is a competitive advantage.
Absolutely. Intelligence is hyper-competitive now, right? Globalized world, everyone's smart. But flexibility, being able to adapt, learn new skills, wait for the right moment, maybe take a pay cut to switch to a field you love.
Saving gives you that power.
It gives you that flexibility, which becomes a massive edge.
Okay, so save more, be humble. Got it.
Yeah.
Now, here's a really interesting point about how we make decisions. The idea of being reasonable over rational.
Yes. This is so important. The core idea is You're not a spreadsheet. You're a person, a screwed up emotional person.
Ah, sure enough.
So when you make financial decisions, don't aim for cold, calculating rationality like a computer. Aim to just be reasonable.
Why reasonable?
Because reasonable is realistic. It acknowledges your emotions, your biases, your need to sleep at night. And because it's realistic, it's more sustainable long term. And sustainability is key in finance.
The fever analogy here was fascinating.
Oh yeah, the Nobel Prize winner, Wagner Jarek, he treated syphilis patients by giving them malaria.
Giving them malaria, why?
To induce high fevers. Because scientifically, fevers actually help your body fight infections. Raising your temperature even 1 degree can slow down virus replication by like 200 times.
Wow, so fevers are good, technically.
Technically, yes, they're a useful defense mechanism.
Yeah.
Yet what do we almost always do when we get a fever?
Take Tylenol or Advil to bring it down.
Exactly. Why? Because fevers hurt, and people don't want to hurt. We choose what's tolerable, what's reasonable for us to endure, over what might be scientifically optimal.
Okay, I see the parallel. We do the same with money.
Precisely. Harry Markowitz won a Nobel for modern portfolio theory, all about rational portfolio optimization.
What did he do with his own money?
He admitted he didn't actually use his own complex formulas. He invested his retirement funds reasonably, using a simple 50-50 stock bond split, basically because it helped him sleep at night. He prioritized avoiding regret over maximizing theoretical return.
So even the guy who invented the rational method chose the reasonable path for himself.
Yep. And remember that Yale study arguing young people should use 2-to-1 leverage on stocks.
Yeah, borrow money to buy more stock, even if it means getting wiped out sometimes.
Mathematically rational over the very long run, maybe, but absurdly unreasonable for any actual human being to live through. Watching your life savings evaporate, that's not sustainable behaviorally.
So trying to be too rational, too emotionless, can actually backfire.
It can be a liability. If it means you can't stick with your plan when things get scary, then that lack of emotional commitment hurts you. Anything that keeps you in the game, reasonably, has a quantifiable advantage.
Especially since we know markets go up over the long term.
Yeah.
Like 100% of the time over 20-year periods in the U.S.
Right. The key is staying invested through the scary parts. And being reasonable helps you do that.
Even Jack Bogle, Mr. Index Fund himself, put some money in his son's expensive hedge fund.
Yeah. He said, we do some things for family reasons. Life isn't always consistent. That's human. That's reasonable. Not perfectly rational, maybe, but reasonable.
Okay, so embrace being reasonable. Now, this next point feels like it could save a lot of anxiety. Surprise, history is not a map of the future.
Huh. Yes. Scott Sagan, the Stanford professor, put it perfectly. Things that have never happened before happen all the time.
So history can teach us things.
Absolutely. It helps calibrate expectations, shows you the range of what has happened, but it is not in any way a map of the future. The future will have surprises.
Because investing isn't like physics.
Exactly. Physics has immutable laws. Finance. It's guided by people's behaviors. And people are unpredictable. Remember Feynman's quote.
Imagine how much harder physics would be if electrons had feelings.
Right. Investors have feelings, lots of them. That makes predicting the future based only on the past incredibly dangerous.
What are the specific dangers of relying too much on history?
One is missing the outliers. The really big transformative events, the Great Depression, WWII, the internet boom, 9/11, COVID, these were mostly unprecedented outliers. They shaped the world far more than billions of everyday events.
And you can't predict outliers from past data.
Nope. Like Nassim Taleb pointed out with the Fukushima nuclear plant, it was built to withstand the worst past earthquake on record. They didn't imagine a bigger one was possible. The real lesson from surprises isn't this is the new limit. It's
The world is surprising. Always expect the unexpected.
precisely. The other danger is ignoring structural changes, things that make the present fundamentally different from the past. Like the 401k and Roth IRA completely changing retirement savings. Or how economic cycles behave differently now, maybe fewer recessions, but bigger consequences when they hit. Even Benjamin Graham, the father of value investing.
What about him?
He apparently kept throwing out his own formulas. He'd say, the situation has changed a great deal. His old rules didn't apply anymore because the market structure was different.
So you can't just blindly apply old formulas.
Definitely not. The further back you look in history, the more general your takeaways should be.
Like what?
Like, greed and fear are constant. People panic under stress. Those behavioral things are timeless. but specific trends, specific trades, what people should do with their money right now.
It's constantly evolving.
Constant. Historians, as the source says, are not prophets.
Good point. And speaking of evolution, there's another layer of change we have to deal with, right? Ourselves.
Ah, yes. You'll change. And your financial plan should too.
This one feels deeply true, but also really tricky. We make these long-term plans,
But your future self is kind of a stranger. It's incredibly hard to make decisions today that will still make sense for the person you'll be in 10, 20, 30 years.
like the friend who spends years planning to be a doctor.
Yeah, works so hard, gets into med school, finally becomes a doctor, and then realizes they actually hate the reality of the job. It happens all the time.
And the stat about college majors was revealing too.
Only 27% of college grads end up in jobs directly related to their major. People change. Their interests, their priorities, their desires evolve.
Psychologists call this the end of history illusion, right?
Exactly. We tend to acknowledge how much we've changed in the past, but we consistently underestimate how much we'll continue to change in the future. We think we've basically arrived at the final version of ourselves.
But we haven't. So how does this square with compounding? Charlie Munger says the first rule is never interrupt it unnecessarily.
Right. But if you change fundamentally, if your goals change, isn't that interrupting the plan? How do you manage that tension?
What's the advice?
Avoid extremes. Aim for balance in your life now. A moderate savings rate you can stick with, enough free time, a commute that doesn't crush your soul, quality time with family.
Why does balance help?
Because it increases your endurance. It makes it more likely you can stick with the general plan for longer without feeling the need for a radical disruptive change later on. It reduces the odds of future regret.
And regret is especially painful
When you ditch a previous plan entirely and feel like you have to sprint in the opposite direction trying to make up for lost time, that's stressful and often leads to mistakes.
So balance promotes endurance. And what about sunk costs, those past goals?
Learn to abandon them without mercy if they no longer serve the person you are now. Don't let the you from 10 years ago dictate your finances today if your priorities have shifted.
Like Daniel Kahneman saying, I have no sunk costs when starting over on a project.
Exactly. Be willing to cut bait on old financial goals that were made by a different person, your past self. That frees up your future self to compound wealth in a direction that actually aligns with who you're becoming.
Okay, so be flexible with yourself. Now let's talk about the cost of investing. The sources say, nothing's free.
Right. There's always a price tag, even if it's invisible.
Like the saying, every job looks easy when you're not the one doing it.
Perfect analogy. Successful investing looks easy from the outside. Oh, just buy good stocks and hold them forever. Simple.
Until you're the one actually doing it.
During a terrifying market crash, watching your account value plummet day after day, suddenly just holding on doesn't feel so easy.
So the real cost isn't just the money you invest.
No, the true price of admission for potentially good market returns is paid in currencies like volatility, fear, doubt, uncertainty, and regret.
And those are easy to ignore when markets are calm.
Very easy. You only feel them when things get rough. And many people try to get the returns without paying this price.
Like trying to time the market.
Exactly, trying to dodge the volatility. The sources compare it to trying to shoplift the returns, get the benefit without paying the cost, but it rarely works long term.
Those tactical mutual funds that try to jump in and out.
They usually underperform. And individual investors often do the same thing, buying high and selling low out of fear, trying to avoid that price of volatility.
So the key is to reframe how you see that volatility.
This is crucial. Don't see market declines as a punishment for doing something wrong.
See them as a fee.
Exactly, like the admission fee to Disneyland. You pay the price to get inside and enjoy the potential rewards, the rides, the experience. Market volatility is the fee you pay for the potential of higher long-term returns compared to safer assets.
And if you see it as a fee, you're more likely to accept it.
You're more likely to accept it as the normal cost of doing business. You'll usually get what you pay for. The trick is understanding that fee, accepting it, and realizing it's the price for potentially great long-term results. Embrace it. Don't just tolerate it.
Okay, paying the fee. Got it. Next up, you and me, understanding different games. This seems critical for avoiding bad decisions.
Absolutely. Think about financial bubbles. They're destructive, obviously. And it's easy afterwards to just blame greed.
But it's more complicated than that.
Often, yes. People inside the bubble are making decisions that seem perfectly rational to them, given their specific situation and time frame. They're just playing a different game than maybe a long-term investor is.
Like the Yahoo stock example from 1999.
Perfect example. The valuation was objectively insane for someone planning to hold the stock for 10 years. A long-term investor would call it crazy.
But for day trader.
For a day trader just planning to flip the stock before lunchtime for a small profit, buying it might have seemed totally reasonable in their game with their extremely short time horizon.
So there's no single rational price because people have different goals and timelines.
Exactly. That's why market commentary can be so confusing or even dangerous. When someone on TV tells you to buy a certain stock,
They have no idea who you are.
right. Are you a teenager saving for a car, a retiree living off investments, a hedge fund manager making a complex bet? Those people are playing completely different games. The advice might be terrible for two of them.
And this applies to spending too, right? Keeping up with the Joneses.
Definitely. A lot of consumer spending is driven by trying to emulate people we admire, hoping to get their admiration in return.
But we don't know their game.
We don't see their goals, their income, their worries, their debts. That young lawyer who feels they need the fancy car and expensive suit to make partner, they're playing a very different game than a writer working from home in sweatpants. You might be benchmarking yourself against someone whose financial life is totally different from yours.
So the key takeaway is,
Know your own game. Understand your own time horizon, your own goals, your own risk tolerance. And crucially, don't get sucked into playing someone else's game or being influenced by people whose situation is irrelevant to yours.
how do you do that practically?
Write it down. Seriously. Create your own financial mission statement, like your example. I am a passive investor optimistic in the world's ability to generate real economic growth, and I'm confident that over the next 30 years, that growth will accrue to my investments.
And having that written down helps you filter the noise.
It helps you ignore advice or comparisons that simply don't apply to your specific game. It keeps you focused.
Okay, know your game. Now, let's talk about something pervasive. The seduction of pessimism.
Yes. Why does bad news seem to travel so much faster and stick so much harder?
The historian Deirdre McCloskey said, "For reasons I have never understood, people like to hear that the world is going to hell."
It's true, isn't it? Pessimism often sounds smarter, more sophisticated. Optimism can come across as naive or oblivious to risks.
But we need to define optimism carefully here.
Right. True optimism, according to the sources, isn't just blind faith that everything will be great. That's complacency.
Is more like.
It's believing that the odds of a good outcome are in your favor over time, even when there will be setbacks along the way. It's a belief in general progress, driven by most people trying to make things a little better most days.
Compare that baseline optimism to some of the extreme pessimism we hear, like that Russian academic Panarin.
Oh yeah, Igor Panarin got front-page coverage in the Wall Street Journal in 2008 predicting the U.S. would literally break apart into 6 different countries by 2010. California joining China, Alaska going back to Russia.
Wow, that sounds extreme and obviously wrong.
Completely wrong. But now imagine the opposite prediction back then. Imagine someone forecasting, say, post-WWII Japan, a nation utterly destroyed would become a global economic superpower within decades.
That would have sounded absurdly optimistic, almost delusional.
Totally absurd. Even though that's exactly what happened, extreme optimism often sounds crazier than extreme pessimism, even when the optimistic outcome occurs.
So why is pessimism so seductive? What makes it grab us?
There are a few reasons. Part of it's just hardwired, instinctual. Loss aversion, Kahneman's Nobel-winning idea, means losses loom larger psychologically than equivalent gains. Threats feel more urgent.
Okay, evolutionary programming.
Also, money issues are universal. A recession affects almost everyone, so bad economic news captures broad attention, unlike, say, a localized natural disaster. Market declines get endless analysis, market rises often get less attention.
True.
Pessimists often just extrapolate current negative trends indefinitely. They don't account for how markets adapt, how people find solutions, how ingenuity kicks in.
Like the predictions of running out of oil.
Yeah, people forecast we'd run out of oil constantly. Lester Brown did it again in 2008. But they didn't foresee fracking technology unlocking vast new reserves. Markets adapt. Problems often create their own solutions.
And there's the speed difference, right?
Huge factor. Progress is usually slow, gradual, almost invisible day to day. But setbacks, they can be sudden, dramatic, and highly visible. There are lots of overnight tragedies. There are rarely overnight miracles.
Like the Wright brothers' flight versus a plane crash.
Perfect example. It took years for people to grasp the world-changing significance of that first flight in 1903. But a plane crash. Instant global news. Same with health. The death rate from heart disease has dropped 70% since 1965, saving 500,000 lives a year in the U.S. That's incredible progress.
But it gets way less attention than sudden tragic losses.
Exactly. This applies everywhere. Businesses fail overnight, success takes years, reputations are built over a lifetime, destroyed in an instant. Bad news is just faster and louder.
But there's a weird upside to pessimism.
Kind of an ironic twist, yeah. Stephen Hawking, paralyzed at 21, said his expectations were reduced to zero. Everything after that felt like a bonus.
So low expectations can.
Pessimism can lower your expectations, which narrows the gap between what might happen and what feels like a great outcome. If you expect disaster, anything less feels like a win. It's a strange way to find contentment.
Okay, we have covered so much ground. Let's try to bring it all together now. How do we take all these psychological insights and turn them into actionable advice for you, the listener?
Well, first, the overall ethos should be like modern medicine. It used to be doctors just told you what to do, no questions asked, like that dentist in the 30s who pulled 16 teeth without consent.
Crazy.
But now it's a partnership. Doctors offer options based on their knowledge, but you, the patient, decide what aligns with your values and goals. Financial advice should be the same. No one can tell you exactly what to do with your money because they don't know you.
But there are some guiding principles that seem pretty universal based on everything we've discussed.
Absolutely. Let's list some key ones.
Okay, number one, less ego, more wealth. Remember, wealth is the gap between your ego and your income. Humility builds wealth.
2, manage your money in a way that helps you sleep at night. That's probably your best guide, even if it's not maximizing every last penny on paper. Reasonable over rational.
3, increase your time horizon. Time is the most powerful force. Give compounding room to work.
4, be okay with a lot of things going wrong. That's normal. Focus on the few big wins, the tails. Don't expect every investment or decision to be perfect.
5, be nicer, less flashy. Real respect comes from kindness and humility, not horsepower.
6, just save. Save even when you don't have a specific goal. That saving buys you freedom and resilience against surprises.
7, define the price of investing volatility, fear, regret, and pay it willingly. See it as a fee, not a fine.
8, worship room for error. Margin of safety in your plans gives you endurance, and endurance lets compounding work. It's a hedge that pays off hugely.
9, avoid extremes in your financial life and your career. Your future self will thank you. Balance reduces regret and increases endurance.
10, like risk, but fear ruinous risk. Take chances to get ahead, but never risk everything. Avoid anything that can wipe you out. Survival first.
11, define your game. Know your timeline, your goals, and don't get swayed by others playing different games.
And finally, 12, respect the mess. Smart people disagree about money because it's personal. Goals differ. There's no single right answer, only what works for you in your unique context.
Those are fantastic principles.
Right.
Now, maybe for a little confession time, how do I personally apply some of this? What works for me?
Yeah, let's hear it.
So my main financial goal has always been independence. Not necessarily getting rich in the flashy sense, but having the freedom to wake up and know my family and I can basically do what we want on our own terms. Control over time.
That core value we talked about.
Exactly. And I was really influenced by our parents. My dad became a doctor later in life at 40, and they consciously lived well below their means, saved a ton. That financial strength eventually allowed him to just quit a super high-stress ER job after 20 years, simply because he'd had enough and could.
That's real freedom.
It made a huge impression. So my wife and I, even as our incomes grew over the years, we've basically kept the same entry-level lifestyle we had in our 20s. Pretty much every dollar of raise just went into savings, our independence fund.
That takes discipline, but it removes pressure.
Immense social pressure.
Yeah.
And we made some unreasonable choices because of this independence goal. Like, we own our house outright, no mortgage.
Financially irrational, some would say, losing the tax deduction, the leverage.
Totally. On paper, probably the worst financial decision we've made. But psychologically, the best money decision. That feeling of independence, of owning it free and clear, is worth more to us than the theoretical extra return from investing the difference. Sometimes you just have to choose happy over right.
Aligning money with your value.
Exactly. And we also keep a pretty high percentage of our assets, maybe 20% outside the house, in cash. Just sitting there.
Also irrational, according to standard advice.
Yep. But for us, that's the oxygen of independence. It absolutely ensures we will never be forced to sell our stocks at a bad time just because the car breaks down or the roof leaks, those little financial field mice that always pop up.
So that cash provides resilience.
Totally. Beyond that, our investment strategy is boringly simple. Just invest consistently every month into low-cost, broad index funds. Plan is to do that for decades and let it compound. I really believe effort and results aren't strongly correlated in investing tails drive returns. So my focus is on what I can control. A high savings rate, patience, and maintaining that long-term optimism. I can afford to not be the world's greatest investor, but I really can't afford to be a bad one. Survival and consistency are key for me.
That makes a lot of sense, connecting back to all those principles. Now, just as a final thought, a kind of postscript, maybe we should touch on why we in the U.S. tend to think about money the way we do today. A little history lesson.
Yeah, good idea. Because the economic world of, say, 1945 is almost unrecognizable now.
Totally. Back then, after WWII, the main fear was another Great Depression. You had 16 million GIs coming home, huge housing shortages, massive economic uncertainty.
So what happened?
Well, partly to manage war debt, the government intentionally kept interest rates incredibly low, like 0.38% for years. This made borrowing super cheap.
And the GI Bill.
Gave returning soldiers unprecedented access to mortgages, often with zero money down. Combine that with the first credit cards appearing in 1950, debt becoming tax deductible. Boom. Consumer credit exploded. Household debt actually grew faster in the 1950s than in the 2000s housing bubble.
Wow. And this happened alongside rising incomes.
Yeah, there was this hidden productivity boom from the Depression and war years. Factories switched to making consumer goods, wages doubled, and importantly, the gains were shared much more equally back then. The gap between rich and poor actually narrowed significantly.
So people felt like they were all rising together.
Largely, yes. Lifestyles became more similar, influenced by mass media, just 3 TV stations showing everyone the same picture of the good life. People compared themselves to their neighbors, their peers, and because incomes were rising steadily, the increasing debt felt manageable.
But then things started to change around the 70s.
Yeah, 1973 was a turning point. Recession, high inflation, oil shocks, Vietnam, social unrest. U.S. economic dominance started to fade. And a new generation, the baby boomers, had very different expectations than their parents. Crucially, economic growth started becoming much more uneven.
But the expectations of equality remained.
That seems to be the case. People still expected that shared prosperity they saw growing up, even as the reality shifted. Then came the next boom, roughly 1982 to 2000. Good growth overall, but
Profoundly unequal.
exactly. Massive gains at the very top, much slower growth for everyone else. The top 1% income grew, 86% from 93 to 2012, while the bottom 99% saw only about 6.6%.
So the rich got much richer.
And lived much more lavish lifestyles. And thanks to advertising, cable TV, the internet, those lifestyles became highly visible, inflating the aspirations of the majority whose incomes weren't keeping pace.
Leading to keeping up with the Joneses on steroids, funded by debt.
That's the argument. People stretched further and further. Bigger houses, fancier cars, more credit card debt, huge student loans, trying to maintain an image of success that didn't match their income reality. Household debt to income went from 60% in the 70s to 130% by 2007.
Unsustainable.
Clearly.
Yeah.
And even after the 2008 crash, many policy responses like QE, bailouts, tax cuts tended to benefit asset owners and higher incomes more, arguably perpetuating the inequality even as overall debt levels came down somewhat.
So the underlying tension remained
Yeah.
between the expectation of broad prosperity and the reality of widening inequality.
It seems so. And that gap, amplified by seeing everyone's curated lives online 24/7, helps explain some of the frustration and polarization we see today. Movements across the political spectrum basically saying, the system isn't working for me the way I thought it would.
So history shows us how these expectations got set and how the reality diverged, shaping how we feel about money today.
Yeah, economics is always changing, always cyclical. But that gap between expectations and reality can be a powerful force.
Wow. Okay, so wrapping up this deep dive, we've covered so much. How our own unique experiences shape us, the huge role of luck and risk, the danger of never enough, the magic of compounding over long periods, the absolute necessity of survival, how extreme tails drive results, why freedom and control over time are the real prize, the illusion of visible wealth, the simple power of saving, why being reasonable beats being rational, the limits of history as a guide, the fact that we change. It all weaves together.
It's incredibly interconnected, and it really emphasizes how personal finance truly is.
So maybe the final thought for you, our listener, is this. Given that your own personal experience is just this tiny sliver of all financial history,
Hmm.
and given that the future you is likely someone you can't fully predict today,
How much of your current financial plan is genuinely flexible? Flexible enough to handle a world that will definitely surprise you, and flexible enough to adapt to a future self you might not even recognize yet.
how can you embrace both the market's unpredictability and your own unpredictability to build a financial life that's not just successful on paper, but resilient and genuinely fulfilling for the long haul? Something to think about.